Good morning and welcome to the Orlando Real Estate Buzz. I'm Brendan Rendo with the Homes in Orlando team, and Joe's not able to join us this week, so we're going to go and run this one solo. Got a couple things, important things to bring up that came out this week. Number one is inflation numbers came out, and they were better than expected, down around about 2.4%. Then we've also got the home builder confidence, which really is not very high at all. And then we're going to look at, of course, the Orlando numbers and wonder when are we ever going to get out of these doldrums. So hang on tight. And again, welcome to the Orlando Real Estate Buzz. So this week we had the new inflation numbers come out, and we had some feedback from the Fed on how they felt about the inflation numbers. So when we get into the numbers this week, we'll see that we're currently at 2.4% for the 12 months ending in January. That's the best we've seen in a number of years, which you would think would start making the Fed feel like maybe they should start to cut. But the big thing in there, and this is why you always got to look a little skeptical at the numbers and really kind of go in and pull them apart, is where are we seeing the best numbers for inflation? And right now it's in the energy sector, where gasoline is down 7.5%. and fuel oil is down 4.2%. So that's helping to keep the overall numbers down. But the number that keeps bothering me, and we've discussed this several times, because in this world of AI, why are they not using real-time data? It doesn't make any sense. And that's with the shelter number. And we're still seeing a 3% interest rate on the shelter number. And it doesn't make any sense to me, because in real time, rents are coming down. I know here in the Orlando area, we're seeing a number of rental properties having to cut their asking price, very similar to homes for sale. And, we're talking, probably a 3 to 4, 5% decrease in what they were previously getting, maybe even a year and a half ago. And you can see that actually nationally, in that through all units, we're actually seeing about a 4% discount on rental rates. So when you're looking at that, and then we go back to the numbers that are being shown by the inflation numbers, it just doesn't make any sense of where we're coming out. So I think inflation may actually be lower than the 2.4%. And if that's true, why can't the Fed start to do some cuts? So we got to keep looking at that, and keep asking ourselves, why are they not cutting rates? So how has the Fed reacted to this? Well, interesting enough, the Chicago Fed president, Goolsbee, pointed out that the current inflation numbers could lead to further cuts in the Fed rate this year. Right now, when we're looking at the betting odds overall, we're looking at 2 cuts this year, basically about 50 basis points, which a lot of people feel that will be the neutral rate. That's the rate that we really need to get down to. About 20 right now, about 27% of the market feels that we're going to get 2 cuts this year. Of the three cuts, we got about 23. So we may start to see this slide a little bit, that people are thinking we're going to get more cuts. I think we're going to get 2. Do I think we get one before Greenspan? his term is over? No, because it's coming up very quickly. So, but I think right after we see the new Fed chief sworn in, I think we may end up getting back-to-back cuts. So that again, how it will help or hurt the overall market. What we're seeing right now is the T-bills, the 10-year T. We've gotten some relief on that on the overall rate. Past couple of weeks we've been up around, the 4.29, and we've dropped to 4.08. But the thing that we're not seeing the benefit is in the spread. As we mentioned several times, that spread between the 10-year and the 30-year mortgage is something that we need to keep an eye on. We had dropped to about 1.8%, but we've lost about 0.2, and we're back up to roughly a 2% spread between the 10-year T and current interest rates. Mortgage rates this morning were looking very nice, 6.05. So we're basically at that 6% window. Surprisingly, we're not getting a number of mortgage application increases that I thought we might. I think people, I thought maybe the 6 is where we see a little bit of a breakout. People are still holding their cards close to their chest. I think there's still, if we drop to a steady maybe 5.875, that mental barrier of being below that 6% may be the thing that actually starts to push people back into the market. But for right now, even at that 6%, we're not seeing the big influx of mortgage applications that we thought and had hoped that we would see. So just something to watch. So if there's any way to put some pressure on some of these wholesalers, some of these programs to cut that spread again, because we've got that room. Because remember, historically, the spread between the 10-year and the 30-year 10-year treasury bill and the 30-year mortgage is usually about 1.5%. So we definitely have some room to reduce that spread and actually help push this market back into a favorable one for people. So while all this is going on, we're also watching builder sentiment, and this is important because housing construction is such a major part of the American GDP, and right now builders are not feeling it. The number of housing starts has decreased. We're down about 4% over last year's numbers. And it comes down to what we've been saying, was the word of 2025 and is the word of 2026. And that is affordability. And the home builders are saying the same thing. Housing affordability remains an outgoing challenge at the start of 2026. With them knowing this, I still don't understand why the homes they're building on average here, at least in Orlando, are in that 400,000 and above range. I actually was going through for a custom builder last night through Winter Park and looking at all the permits for demolitions in Winter Park. And there were 129 homes purchased and demoed in the past year in Winter Park. And the homes they're building are $2 million homes, roughly $1.5 million, $2 million, $2 million and a half dollars. So it's interesting in that here in Winter Park that market is thriving tremendously. So just, it's amazing how the high end and the low end, I guess you would say the low end, what a dramatic difference there is. Because the builders right now, again, are cutting a number of their prices. In this past month, they've had about a 36% price cuts in their inventory. That's a large number of price cuts. And the other thing is that the average price cut of builders right now is roughly about 6%. So I keep telling people that, my buyers, is that we really do need to look at new construction and see what incentives there are and what we can negotiate as far as incentives, because the inventory has increased tremendously for these builders, and they're holding a number of properties. One of the biggest places I see it is in the townhome market, where the builders have built a number of smaller townhome communities, but they're asking 400, 450, $500,000 for a brand new townhome, and they're not moving. I got an email from a builder in Apopka, and I believe he had 18 houses, and I believe 5 of them were sold, and the rest are finished and sitting. And that's somewhere where, as a buyer, if you're in the townhome market, or if it's a place you feel you might be able to start, that you can take advantage of what the builders are providing. And that 450 price now becomes just as affordable as a 400,000 or 375,000 with the mortgage incentives that they're providing. I actually got a email from Miranda Homes that they were offering an intro rate of 1.99%. That just stinks of desperation. To have to offer a 1.99% on a home is unbelievable. Yeah, I mean, I'm starting to wait. I'm waiting for the no payments for 12 months scenario. That should be next from some of the builders. So we've got all this going on, and the market here in Orlando has continued to really just move along. No real chugging, but man, we are in the slow lane. We just can't seem to get out of second gear in this market right now. And when we look at our numbers, you'll see that sales continue to sit below 400 homes. With this size market and the number of homes on the market, we should be up around 500 homes per week being sold, and we do not have that right now. So that continues to be a concern. What I would like to see, and not sure how, where rates have to get to really get people off the sideline. But I would really love to see that number back up around 500, 550. And as a buyer, knowing that the houses aren't selling, days on market continues to stay up around the 72 days, there is a lot of bargaining room in these homes, and it's a great time to take advantage of it. Here we are with inventory again increasing, so our inventory is going back up. So there's more homes on the market, and this I believe, is going to continue to happen and actually increase over the next several weeks, because March tends to be a very high month for new listings. Our condo market just stagnant as can be. If it ever broke out of that 100 range, I would jump for joy. And again, that inventory continues to increase. Then we look at the breakdown of the numbers. How homes we have roughly about 5.5 months, a little over 5.5 months of inventory overall. But then you look at the homes over $1 million, and they're sitting at 14 months. So a lot of these homes are sitting on the market. And if you're in that market, know your numbers so you can take advantage of it. And our original list to sales price, we're sitting roughly about 93.38, which again is a very aggressive number. And look at this. here in the 250 to 300 range, we're actually down to 90% of the original price. So if you're looking at a home that's $300,000, chances are that that home is going to sell for around $270,000. And I think a lot of that is just the current interest rates and where people feel comfortable with the overall numbers. And these people normally, these are working people that need to sell for one reason or another, and now hey, they're having to make deals that they really don't want to make. And you see their days on market is actually sitting at 96. So those are the ones that are sitting on the market the longest, and of course then you're getting the biggest discount. Then we look at our weekly sales. Again, you see here's that 400 line, and we really have been below it for a couple months now. Want to see that push back up. And then our inventory, we're up about 7% over last year. That's nice to see. I think we're probably going to get back up to that 9,000 level sometime towards the end of March. Because again, spring, that's when people start putting their houses on the market. So as a buyer, if rates stay in this area, again, take advantage of it. Know that you've got options. And this was something that I just wanted to look at because we've heard out there that foreclosures are increasing, short sales are increasing, and yeah, you're actually starting to see it. And slowly since October of last year, where we had roughly about 81 short sales, about 32 foreclosures, we're slowly starting to creep up in the foreclosure market and in the short sale market. And I think we're going to start to see more of these. I think it's more of the short sales. And then the ones who are going to be in trouble are the ones who bought in 22 and 23. And we have now seen actual price reductions, loss of value here in the Orlando area. And I think that is going to cause more short sales as people need to move. And they look at their overall numbers. They look at the cost to sell. I think it'll probably push up for sale by owners because people are going to say, "Oh, I can't afford to cough up $25,000, $30,000 to sell my house." The short sales aren't going to be much. It's just going to be that they're upside down enough to where they've got to look at doing a short sale. So those are our numbers for the week. Thank you for joining us on the Orlando Real Estate Buzz. Please like, share, and join us every week here at the Orlando Real Estate Buzz. Thanks and have a wonderful day.